What if I told you the stock market doesn't just move on logic? It often moves like a crowd at a concert, a stampede, or even a rumor spreading through a small town. That's the idea behind stock market bubbles, and if you understand them, you don't just learn how crashes happen. You learn how to spot the signs that everyone else is getting swept up in the same story. A stock market bubble is when prices rise far beyond what the underlying business is actually worth. Not because the company suddenly became magical, but because people keep buying, expecting someone else to pay even more later. That creates a loop. Prices go up, excitement grows, more people pile in, and the rise itself becomes the reason people buy. That's what makes bubbles so fascinating and dangerous. Here's the key mechanism: bubbles aren't usually caused by one bad decision, they're caused by feedback. When assets rise fast, investors feel smarter, safer, and more confident. Media coverage increases, social proof kicks in. Friends talk about gains, people start to believe if it's going up this much, I can't miss it. That belief can overpower fundamentals for a while. Valuation stops mattering as much as momentum, and once that happens, the market starts pricing in perfection. That's a fragile place to be. Understanding bubbles is useful because it helps you separate a great company from a great price. Those are not the same thing. A company can be excellent and still be wildly overvalued, and when expectations get too high, even strong earnings can disappoint. That's often when bubbles burst, not because the business is worthless, but because reality finally catches up with the price. Think about the dot-com era. Internet businesses were real, the internet itself was revolutionary, but investors got so excited that many companies were valued as if growth would never slow down. When that didn't happen, prices collapsed. Or look at the housing market before the 2008 crash. People believed prices could only go up. That belief fueled more buying, which pushed prices higher, which reinforced the belief. A classic bubble loop. So what can you actually do with this knowledge? First, watch valuation relative to reality. If a stock is rising much faster than revenue, earnings, or user growth, that's a warning sign. Second, pay attention to the story around the investment. When the pitch becomes emotionally charged, like this time is different, it's guaranteed, everyone is getting rich, that's often when risk is highest. Third, look for concentration. If nearly everyone on one side of the trade already agrees, there may be fewer buyers left to keep pushing prices higher. And finally, use bubbles to stay disciplined. You don't have to predict every top. You just need to avoid confusing hype with value. Stock market bubbles are powerful because they reveal something very human. We don't just buy assets, we buy beliefs about the future. And when those beliefs get too far ahead of reality, the result can be explosive. If you can recognize the pattern, you gain an edge, not by timing every bubble perfectly, but by making better decisions while everyone else is losing perspective. Stock Market Bubbles 101, the most fascinating patterns every investor should understand, is just one small part of stock market bubbles, crashes, and investing basics. If you're interested, our full free Stock Market Bubbles, Crashes, and Investing Basics course is linked in the description.